Let's get started with this week's market insights. The stock market has been powering to new highs on a weekly basis for several weeks in a row now, boosted by positive trade headlines. But do the new highs signal a sustained continuation of a long bull run, or is it time to get defensive? Here with me now to discuss market conditions and analyze a few stocks is Randy Watts, Chief Investment Strategist at William O'Neill & Company. Thanks so much for joining me today, Randy.
Thanks for having me back.
All right, so we've seen quite a few up weeks and new highs in a row now. What's your take on what we've been seeing lately?
Well, first, the technical picture of the market has greatly improved and is actually pretty positive right now. If you look at years where the market has this kind of a move in the first 10 months, normally it has better than average returns in November and December. So the setup for the end of the year is very good. In addition, in years where the S&P goes up 25% or more since 1928, 71% of the time, it's happened 17 times, 71% of the time the next year is also an up year positively. And then if you look at sort of underneath the broad indices, right now 9 of 11 O'Neill sectors are above their 50-day. That kind of breadth is encouraging. And in addition, over the last 4 weeks, technology and healthcare have been doing better. So that's good for growth stocks. So that's actually making us feel more confident about the move we're seeing right now.
That's right. We are seeing a lot of momentum. So you think that bodes well for a next big leg higher, although there are others out there who are saying it's time to get defensive.
Normally, when you have this kind of technical action, it does carry forward. And then I think the market's really being driven by three things right now. The first is that earnings season, which has just completed, was better than people expected. People had pretty negative views going in, and it ended up being better. And it looks like hopefully forward 12-month earnings estimates for the S&P 500 are starting to firm up and stabilize. Second, there's been a lot of liquidity pushed out by the central banks. If you look at the PBOC from China, our Fed, the ECB in Europe, and the Bank of Japan, those central banks have all been adding liquidity. And in fact, October was a month that saw the most liquidity added since last December. And some of that liquidity is clearly finding its way into U.S. stocks. Finally, active investors in general are behind the market indices. So I think there's a little bit of a catch-up trade as active managers try to keep pace and improve their performance relative to what the market's done this year.